The cash cycle is actually very important. It's not in the study design. The reason why it's not listed in the study design is because it's something we already know. And most importantly, it's something we need to know. It's simply the total time that it takes a business to sell stock to customers, which we measured in our stock turnover in days. And then for the sales that have been made on credit, the average time it takes to collect those amounts owing from debtors, which is measured by our debtors turnover ratio in days. So together, the cash cycle is very easy to calculate. It is our stock turnover in days plus our debtors turnover in days, and that will equal our total cash cycle. So looking at how a business works, the cash cycle simply looks at the way a business runs in that it buys stock from suppliers on credit. It then sells that stock to customers, and we measure that with our stock turnover ratio in days. For a lot of those customers, there'll be sales that have been made on credit. So we measure that time it takes to collect those amounts with our debtors turnover, and together that whole process is called our cash cycle. So all that happens now is it starts again. Once a business has collected money from debtors, it buys more stock, it then sells it to customers, it then collects the amount owing from debtors, and then it buys more stock. And then it simply sells it to customers, it collects the money owing from debtors, and so on. So for example, a firm has the following ratios. It's a stock turnover of 38 days and a debtors turnover of 24 days. The cash cycle is simply those two ratios added together. We'll take the 38 days that it takes to sell stock on average, and then the 24 days it takes to collect debtors on average, and that is a total of 62 days. So what does that mean? Well, it means that our first step of the process, after we bought stock, was then selling it. That on average takes 38 days for this business to sell. The second step was, though, for customers who bought on credit, we then need to collect their amounts owing. So the debtors turnover ratio measured that, and that was 24 days. So together, it's taking us 62 days to sell stock and get the money for it. Looking at it as a trend and how to interpret it, if it was 62 days last period, the cash cycle, and then it went down to 54 days this period, we would say that's a good result. The firm is taking less time to convert stock into cash. There's other factors we need to consider, such as are we just selling stock at a loss or giving out excessive discounts, but on face value, we'd say that's a good result. On the other hand, if it went up from 62 days to 75 days, we would say that result is a negative result because the business is taking more time to convert stock into cash, and that means we're going to have to find money to pay our bills from another source, and that's where we get into problems. So on its own, that would be a negative result.